You're listening to Indications by the Conference Board.
Hello, my name is Ilaria Maselli, Senior Economist at the Conference Board, and it's a pleasure to welcome you to this edition of Indications podcast, a series brought to you by the Conference Board. Today, I will be sitting down with our Chief Economist, Bart van Ark, to discuss the economic impact of the COVID-19 outbreak on the euro area. It's been 3.5 weeks since Italy is in a lockdown, and shortly after that, other European countries followed. Approximately a third of the world population is currently in lockdown. We are recording this podcast on April the 2nd. And as of today, the death toll in Europe is high. Almost 30,000 people lost their life, unfortunately. And the virus is spreading fast to other parts of the world as well, with 930,000 people confirmed infected and almost 47,000 that lost their life. This is an extraordinary situation, which will have a major impact on the world economy. Good morning, Bart, and welcome. I know you're not far from New York City, so I hope you and your beloved ones are safe.
Yes, hello, Ilaria. Yes, hello from rural Connecticut. So yes, we are fine. But as you say, those are extraordinary times, not only for our friends in Europe, but also in New York, which is not far from here, where our headquarters of the Conference Board is. And we're obviously very concerned about people's health and well-being. So it is extraordinary times, but happy to talk to you this morning.
Thank you. Well, let's start perhaps with a general overview of what type of shock we're going through from the purely economic point of view. Because I've seen a lot of discussion there. Is it a supply shock? Is it a demand shock? What is your take?
Yeah, those are times that you really can't split up supply and demand as we economists would like to do, right? We can nicely put things into boxes, and that's not working in this specific time. But it is true that in a way this, for the moment, is more a supply shock than a demand shock. It basically means that, you know, major parts of the economy have been basically brought to a stop. In particular, of course, sectors that are highly dependent on people visiting factories and stores and restaurants and everything else has seen their revenue declining very, very rapidly. So it's not that consumers didn't want to consume. At this point in time, consumers cannot consume. However, the demand factors are really popping up very quickly now. People are losing their job. People see salary reductions. People are concerned about the health of their household balance sheets and going forward. So very quickly we'll see that the demand element is becoming equally important. And I think the further we go into this crisis, and particularly into the recovery, we may see that demand is actually becoming even more important than supply.
And how does this compare to 2008? Because I think the natural instinct for all of us has been in the last weeks to compare all the variables we can find out there to the global financial crisis. And we've seen, for example, that the stock exchanges went down faster than what happened in 2008. So can we make that comparison? Does it make sense?
Look, no crisis is the same, and certainly this one is very different from any previous recession or crisis that we have seen, because it's so much a crisis that originated outside the realm of the economy itself. So that, I think, is a very, very big difference. And then secondly, although, you know, you can have natural disasters and hurricanes and floods, which are also these external factors, but they usually are pretty localized and they tend to go away pretty fast over time. And those two things are not the case now. I think it's very interesting to see how we are reacting to this in Europe, as well as in the United States versus Asia. Because in Asia, where the problems have been very big too, they were somewhat better prepared because they have had these kind of outbreaks of viruses before. SARS, of course, is the most important in recent history. Whereas in Europe and the US, we haven't seen anything like this since the 1960s. And even at that time, it wasn't as big as it is now. On your question on the financial markets, certainly the financial markets don't give us a good signal about what's happening in the real economy. But you're correct that sort of in the first 20 days or so into this crisis, the S&P 500 that we tracked very carefully was moving exactly the same way as it did after the Lehman collapse. It's only in the last 10 days or so there are slight differences, and that really has to do with the point at which the stimulus programs come through. Because when the stimulus programs come through, the fiscal stimuli, you see the markets go up. We've seen that last week when the US fiscal stimulus came up. Then we had a recovery, but then the last few days it started to move sideways again. So in a way, the trend is still pretty similar as that to Lehman, but that's just maybe more an accident than that it is something that we should draw too many conclusions from.
And there is one more crisis one more shock we should talk about, and that's the oil price, the crash of oil prices. Does it have anything to do at all with the COVID-19 outbreak?
Oh yes, it does. Of course, the collapse in global demand has an immediate impact on the oil price. But again, if you track how rapidly the oil price has collapsed, it is no comparison with any earlier crisis that we have seen in oil markets. And that really has to do because there's a perfect storm here. In addition to the lack of demand, there's a huge oversupply. Saudi Arabia and Russia have not been able to agree on how to cut production. That's a big sort of geopolitical battle that is being fought out over there. I think actually this problem will resolve itself very soon, because what we're seeing now is that actually storage capacity is beginning to run out. So basically storage places are literally beginning to flow over. The countries will have to stop production because there's just no way to pump up more because there are no markets. So I think it will probably resolve itself, but the geopolitical issue is not going to go away for a while.
And in the meantime, we still face a great deal of uncertainty. And I know we've been working on scenarios, and I wanted to ask you to talk a little bit about that, because nobody knows, of course, how long this is going to last, if there will be different waves. So how do we understand what's ahead of us?
Yeah, I mean, this is absolutely not a time to do one forecast. As complicated as it is for people who are using these kind of data, you really have to think in terms of scenarios now. And organizations that are able to use scenarios are showing the kind of resilience they need to have now to be able to respond very quickly to changing circumstances. Because the major factor that we cannot really control, at least certainly not within the realm of the economy, is what is happening to the evolution of this outbreak. So the underlying assumptions around what is happening to the virus itself is critical for any kind of scenario that you develop. So we basically have four scenarios at the moment. And the first one, which is perhaps the most optimistic one, we probably already need to drop by now, because that scenario would assume that we will see a peak in the new COVID-19 cases being added by mid-April. We might see that in some regions in Europe, but in some regions in Europe that will be later, particularly in the UK, but also some continental European countries. Also in the US, we're probably likely to see that peak later in the month and not by mid-April. So a quick recovery coming after that in May is already sort of out of the window. The second scenario is actually what I feel is a bit the most concerning scenario, and that is that the peak will be much higher in terms of new cases. And that's obviously very concerning from a humanitarian and healthcare perspective. But this is also concerning from an economic perspective, because if we get a higher peak, it also becomes much harder to control. So there's a risk of escalation. And therefore, any kind of economic outlook based on that kind of escalation of the situation makes it very, very uncertain where the economy would go. You would get a very deep contraction in Q2. I mean, we could lose, up to 15 or perhaps even 20% of GDP in one quarter. Is totally uncontrollable. Now, of course, in these kind of scenarios, you get a big V-shaped rebound later on, probably in the third quarter, but it's not going to make up for the loss that you have in the second quarter. The third scenario is the more successful scenario from a humanitarian point of view, in the sense that we will be able to flatten out this curve. This is now very well known. So the fact that you spread the number of cases over time, that would obviously help to reduce the impact on the healthcare system and save lives. Economically, it is true that that could create some more pain, because in a way you are kind of extending the contraction over a longer period of time. What we find, however, is that at the end of the day, the contraction is not going to be all that deeper, even in a rather optimistic assessment of the deeper contraction. In other words, what it basically means is that scenario is much more controllable. You are in problems for a longer period of time, but you also have more time to prepare yourself on how to get out of this. And that's very important, because the recovery may look very different from other recoveries, right? We're not going to go back to work right away. There will be regulations on under which conditions can businesses start up again. How many people can there be in an office building? What is the distance between tables and restaurants? How many people can be in a store at one point in time? So for companies to really think about how do we do business in that kind of new normal takes time. And in a way, we might as well use that time to get ourselves ready. And that last point is important for the fourth scenario, because of course there is now concern that we may not be through this by the summer, that things may get somewhat better over the summer, but that we'll have a resurgence of cases in the fall. And we need to prepare for that. We don't, of course, know how bad that would be. Hopefully, we'll have some medication available that would fight, mild cases, which would bring more, make less people sick, or it would fight it at a more serious end, so that we reduce the pressure on the healthcare system. But in any case, the other thing that's important is, again, how well prepared are we as businesses to deal with these new cases? Hopefully we have lessons learned, and therefore we can reduce the impact on the economy. So in that case, of course, we'll have somewhat of a recovery in Q3, but Q4 then again will give us a weaker outcome. And that of course would even lead to a larger contraction over the year. So it's complicated, these four scenarios. But I do think it's important for companies to think through how they should respond to each of those as they may occur.
And I think it's also useful to add another piece of information, which is the economic impact translated into simple numbers for GDP growth for 2020. And what we have for Europe is that for the summertime V-shaped scenario and the fall recovery scenario, we have basically a contraction in the range of -4 or to -5% for 2020. And how does that compare to US and China?
Yeah, so, well, start on the US. So the contraction in the US is probably somewhat deeper. And I think the reason for that is that in Europe, you get these sorts of what we call automatic stabilizers. So, when an economy contracts, you automatically get some stimulus effects. These are probably somewhat bigger in the case of Europe than they are in the United States. So the contraction in Europe, I think, in the V-shaped scenario would still be about -5% year over year. The recovery in the fall would probably make it -6%, whereas a resurgence of cases in the fall would push it even up to perhaps -8% or something like that year over year, 20 over 19. But again, it also depends on how quickly the US stimulus programs kick in. At the moment, we have this relief program. We may have a stimulus program coming later on. And that could, of course, give a little bit of support to the economy, certainly in the second half of the year. China is a whole different story. Of course, China has seen a big hit in the first quarter because the crisis hit at that time in January already. The question there is really how big is the recovery currently that we're looking at now, heading into the second quarter. And it's a complex story. Most factories in China are back to work. Most workers are back in the place where they are working. So
that's
measures now.
About 70%, according to our colleagues from the China Center, right?
Yeah, well, even perhaps in some sectors, perhaps even more. The problem is that what capacity do they work? And there you see that it varies between sort of 40 and 70%. And that is because, we were talking about supply and demand factors before. Demand factors are really going to kick in China now because, the factories may back to work, but there's no demand anymore. I mean, it's striking how only 2 months ago, the problem was that we couldn't get anything we wanted to have from China. Now, the point is that we don't want to have anything from China. So it's been kind of a complete switch from a supply constraint to a demand constraint within a period of a few weeks. It's amazing. So the question really is, can China recover because there's no global demand? And on top of that, the domestic economy is also really recovering very, very slowly, which goes back to my earlier point, is that people do not right away go back to their normal way of life. There's lots of restrictions, lots of travel restrictions, lots of restrictions on how many people can go where at what time. And we have recently even seen a little bit of a resurgence of new cases in China. And you can see that measures have been taken actually to shut down the economy again a little more, not as bad as in January, but you can really see that W-shaped scenario potentially evolving in the case of China.
Right.
So let's change the role a little bit, Ilaria, because this is, you're not interviewing me, right? I should also sort of ask you a little bit on what is going on in Europe in particular. Because let's talk a little bit about some of the larger European countries, because obviously they're impacted in different ways. We know how terrible the situation in Italy and Spain is. Germany seems to be doing somewhat better. So does France. The UK has been late in terms of taking the measures. It's now seeing serious problems. So how is this all working out from an economic point of view?
Well, of course, it's not easy to compare the large European countries because, as you said, there is an issue with timing. So Italy went, let's say, into the crisis a little bit earlier, more or less 3 weeks earlier than the other countries. Then Spain follow, and now the later ones starting the restrictions was the UK. And also it's not easy because we don't have a lot of real data points for Europe. We have some confidence surveys. So for example, we have seen the PMI, the Purchasing Managers Index, that gives an idea of how companies see this and what they see happening. And what this number says is that we're going from a level of, let's say, confidence in the range of 50 something to a level that is around 30. So it's a major shock that European companies are seeing. On the side of consumer, again, very difficult because the data we have are not very useful because the interviews were run before the real start of the outbreak in all countries. So we only have one data point for the Euro area as a whole, and it showed the largest fall in consumer confidence in one single month since the numbers have been recorded, basically. So it's difficult to make a proper assessment without real data, and we're going to have to wait still a couple of weeks to get something interesting from that point of view. But there is a lot happening in terms of policy responses. And we also know that, we also estimated that if we look at the retail trade side, we know that, okay, there are some countries with more restrictions, some countries with less restrictions, but still more or less we estimate that 50% of retail trade, it's still open and it's still happening. Of course, a good question is what's happening to the remaining 50%, what will happen with the rebound? And some of it will rebound in the sense that, let me make an easy example. If I need to change the washing machine, I'm just going to postpone that. I cannot buy one now because the shops are closed, but as soon as they're open, I'm going to replace it. Some other things are not going to rebound that much in the sense that they're lost. So let's say if I really like going out for dinner with friends, but I'm not going to have 2 dinners in the same evening just to recuperate the one that I missed in this month.
Yeah, we've seen the same thing in the United States. I mean, first of all, on consumer confidence, we actually released our consumer confidence index just last Tuesday. Again, most of the interviews were kind of completed before the pandemic was announced on March 11, although some of them were taken later. But we already see, even at that point in time, a very large decline in the expectations portion of consumer confidence. So the forward-looking perspective, the decline by 20 points just in 1 month, and that is very rapidly. But the bottom isn't there yet because, you know, in the global recession, I think currently the expectation index stands at just above 80. In the global recession, it went down to about 30. So it still has a long way to go. And I think the real difference with the global recession is the speed by which the decline in consumption, in confidence is happening. And that, of course, has to do with all the examples that you're giving of shop closures and things like that. So people are just sort of hit with this crisis in the face. But I think the other thing I wanted to say is that you make a good point about not everything has come to a halt. If you take retail, for example, grocery stores actually have been doing well. That's partly because of all the stocking up that people have been doing. But also grocery stores are trying to adjust to the new situation very rapidly by putting in some kind of regulations at this point in time. But then if you take department stores and other stores that are depending on consumer durables, they are in deep, deep trouble. They may get some of the pent-up demand later on in the year, but for the moment, they basically completely stopped. So there are very different kind of responses in different parts of the economy. And also in the recovery, we'll see probably very different patterns in the way that companies are going to recover and get opportunities to grow again.
Yeah, and actually, if you think there is a lot, well, of course, we're focused on what is closed and what is going down in the numbers, but by looking at conversations I had in the last week with our members, I heard more than once of companies that are struggling to keep up with the demand, actually, because there's been an increase in demand, also because people are buying as much as they can in these days. And so they don't have enough workers. So we have this paradox situation where a lot of people are temporarily laid off and they have to stay home and they're locked down and there is nothing that they can do. And other cases where there is a shortage of workers because, of course, some people are also on sick leave and they don't have a way to replace them and keep up with increasing demand. And on top of that, I hear a lot in the field of agriculture, related to agriculture, because of course, now that spring is starting, there is a concern that a lot of workers in the agricultural sector normally come from other countries, and I'm sitting here in Belgium, but it's I heard the same for the UK, I hear the same for Italy, and so companies in the agricultural sector are worried because they won't be able to get workers to move and pick up strawberries.
Yeah. So, the one thing I want to say, and then I think we need to move on to another topic which you already raised earlier, which is policy. But the thing that I wanted to say before we go there is that the positive part of this is that you see how inventive the human race is, and all the examples you see in the business community, but also just around you, of people taking initiatives to, first of all, help each other, which is the most important thing, but also to see how can we keep businesses going, how can we keep people employed, what are new opportunities that we can do in order to be able to make ourselves a living. Is pretty amazing. And I see that from the level of really small companies trying to do that to very large companies that are really showing how resilient and agile they can be in order to change the pattern. So that's the hope that I have. That's also why I said earlier, although obviously an extended contraction because of the flattening of the curve, it's worrying from the perspective of how long we're seeing this kind of downfall. But if you use that time in order to think how the new normal might look like and how you're going to respond to that, we may actually come out of it better. And I think that's I think a very important message. But let's go back to some of the policy issues. There's a lot to talk about, but let's focus specifically here, Ilaria, on the issue with employment and jobs. I mean, in the United States, we see this huge increase in unemployment claims, up to 3 million claims last week, more than 3 million. We may have another 2 million this week. This is, of course, particularly concerning in the United States because there's not an easy way to deal with this from a social security perspective. Luckily, in Europe, we're somewhat better positioned, or better instruments in place to deal with, temporary short-time work and temporary layoffs, etc. So, can you talk a little bit about, what's being done in various countries to limit the impact of the rise in unemployment?
Sure, and I think this is definitely a discussion worth having because the jobs part of this crisis is key because the more jobs are preserved at this stage, the quicker the rebound can be when the supply and demand come back after the restrictions are lifted. So I think it's really important to think this crisis in terms of jobs. And I'm still shocked by the increase in unemployment claims that we saw last week in the US in just 1 week. But so let's go to what is happening in Europe. What we see is of course attention to that, and that's made it easier in Europe because we have a lot of programs that are meant to preserve jobs, and that's typically this Kurzarbeit type of programs. So every country has this program where companies pay into a sort of insurance fund that is public, of course, during good times. And then when the tough times come, they can basically fire people temporarily. And in that case, basically the company is able to preserve the job. So people are do not become unemployed, but they become unemployed just for some weeks and eventually even part-time. So this way the job is preserved and the system is very flexible, because every time there is a pickup in demand, and companies monitor that, of course, by the week, they can call back the worker that can immediately start working again in his own job. And we've seen in many countries this system working for a long time. It has different names. It's called chômage partiel in France, chômage technique in Belgium, Kurzarbeit in Germany, Cassa Integrazione in Italy. So all European countries have a form of it. But what we have seen during March is basically an expansion of the programs. So every country, of course, has rules on how this can be applied. And I'll make an example. In Italy, this was meant for big companies, but what they did was to extend for companies of any size the Cassa Integrazione. And I think this is really key, and I think this is the key difference between the US and Europe in terms of policy response, because I think there is an attempt in the US to go in this direction, but of course it takes time to build programs, it takes time to educate companies and workers to use them, and it's not so easy to do in just a couple of weeks.
Yeah, I think that's right. I think it's important to realize that it's not so that there's nothing like this in the US. There is unemployment insurance, and actually there is, in the latest relief bill, the CARES Act, there is 250 to 300 billion for an unemployment insurance expansion. Then, of course, in the US, there's another 300 billion that will be sent in terms of checks to households. Direct checks, so that's a kind of direct financing that is taking place. But I think the real difference, as you say, Ilaria, is the mechanisms by which we can implement this are in place in the case of the European countries, whereas in the case of the US, we now need to find a way, how do we do this as quickly as possible in order to support people who are losing their jobs as well as possible. The real concern is, of course, that companies now have to lay off. They can rehire, of course, when the recovery starts, but let's not forget that we got into this crisis when the labor market was relatively tight, when everybody was crying for talent, and particularly the skilled and the talent and experienced employees, that may be difficult to get them back. So it's important for companies to actually have instruments by keeping these people with them so that they can more easily start the recovery once it happens. So yeah, I think it's very important that we keep following that.
Well, and then the second layer of protection is the income protection. So if you cannot protect the job, at least protect the income. Right. And of course, there US and Europe are more similar in the sense that in the US as well as in Europe, there is forms of unemployment benefits. What is interesting is that on both sides of the Atlantic, these programs have been expanded. So I've seen now that gig economy workers in the US are covered by some sort of income protection along this scheme. And the same is true in Europe, where independent workers are getting some help, which was not the case in past crises. So there is some policy developments that are interesting, and more innovation can come on that front as well. But unfortunately, our time is up for today. We will organize another podcast around the topic of the labor market and the labor market policies. For now, I hope you enjoyed our podcast today. And if you would like to find out more, please visit our website, conferenceboard/topics, natural disaster pandemics, for more insights related to COVID-19 outbreak, and TCP/podcast or webcast for more interactive programs. Thank you so much, Bart. Please stay safe. Everyone stay safe.
Same to you, everyone. Stay safe. Good to talk to you.
Thank you and goodbye.
Thank you. Bye.
This has been Indications from the Conference Board.